early stage venture capital. So we've heard this morning about the contraction of the venture capital business. A bear market that can last for 3 years. Uncorrelated niche opportunity, how emerging managers generate the best performance. Well, we start companies in good times and bad. I've been through several downturns and done very well. As Tim Draper just said this afternoon, we will paddle hard before there is a wave. In many ways, this is the best time to be starting companies. So we're raising a $75 million fund to back medical companies with what economists call low price elasticity of demand. Only companies that save lives, deep science. We've done this before very successfully. Our companies won't need additional capital until the next cycle starts. Recessions historically lasted 18 months since the turn of the 20th century. By that time, our companies will still be running on our capital and can raise additional capital in a very different time. I've been in a huge venture firm. I was Norwest Venture Partners, which is now a $12 billion mega fund. At the time, we had just raised a $500 million fund when I joined them. And I've seen problems before. Large VCs get caught in a squeeze and are forced to focus on saving existing portfolio companies, or they focus on late-stage deals at fire sale prices. Generalists leave the sector. Even specialists face inexorbitant pressure to go late and go big. And there is historically, every recession I've been through, been a drought in early stage venture capital. And that's where we come in. We start companies based on technology that saves or improves lives. Let's see, clicker. Marty, how does this work?
If you can go backward or forward, or I can just, I can move it.
There we go. Yeah. We believe that returns are maximized when operational experienced investors help shape company DNA at the earliest stages. We've all worked as company creators, as founding CEOs, and have track records backing underrepresented founders. We understand that when revolutionary technology is ready for scale up and de-risking in a venture time frame, and that is something that you cannot teach. It is an acquired skill over time and scars on your back. I apprenticed with one of the greatest seed artists in the business in biotech, Larry Bach. Larry Bach was at Avalon Ventures and then CW Ventures in New York. He did 22 companies worth over $100 billion today using this model, using the model we're using. So Neurocrine, Vertex, Illumina, and on. The next slide. Yeah, there we go. List our background. As I mentioned, I've been with Norwest Venture Partners. I also raised a seed stage fund with a group called Medical Innovation Partners that was $35 million. And for the last 10 years, I've been using this model in my own personal investing. We put about $2.5 million to work in 7 different companies. I've had a number of executive roles, a couple of IPOs, lots of venture financings. Most recently, I was the CEO of a company called Megavax, which was acquired in 2016 by Vir Biotechnology. Vir, of course, is now a $5 billion public company with 11 drugs in the clinic, 2 of which are ours. I'm currently an advisor to the Berkeley Skydeck Fund out of University of California, Berkeley, and I've done tech transfer and economic development with ONAMI and the OHSU Biomedical Innovation Program, as well as the University of Washington. My partner, Dr. Laura Smolier, is a PhD chemist from Berkeley. She has been CEO of a couple of different companies and exited successfully. She has 6 years as a founding general partner of another early stage venture firm, the Berkeley Catalyst Fund. Laura has really extraordinary access to the knowledge creators in the San Francisco Bay Area ecosystem at UCSF, at Stanford, and at Berkeley. I tend to work all over the West Coast, all over the Western United States, as a matter of fact. Laura is very specialized in the Bay Area. So our model is to really to invest in 3 stages. The first investment is typically an investment of $300,000 to $500,000 in a university setting in order to de-risk scientific technology and make sure that it makes sense to go forward. A, they can meet their milestones. B, these people aren't crazy. We can work with them. Big deal. And that it makes sense to go on to the next stage. The next stage is $3 to $5 million investment to further de-risk the technology. At that point, we'll put in one of our venture partners who's very experienced entrepreneur. We don't believe in putting green scientists or founders into these companies. It's way too risky, way too expensive. So we bring in a venture partner who's somebody we've worked with before, with the explicit understanding they're in this deal for 2 years. No more. It's an in and out, get this thing up to the point where we can raise a Series A, then we'll recruit the long-term CEO, and they'll back out and do it again. And that's very important because we both, Warren and I have had terrible trouble with getting inexperienced founders out when they're over their skis. It's just, it doesn't work. And then we'll participate in the Series A to about $2 million, but we probably will not go further from the funds from this from this fund.
On the right page? Value proposition?
Yeah. So we believe the model works best when it's kept small, and that if you put in too much money before appropriate de-risking, you lower the returns. I mean, we've seen examples in the last 2 years of, mega financings. I mean, $500–600 million poured into these companies. That is not our style. We don't believe in doing that. We believe in investing money in risk-adjusted allocation. The venture partner strategy we have avoids the inexperienced technical founder in control position, and it minimizes first-time founder failures. I can cite chapter and verse of problems we've had in the past with companies, and we really believe in this venture partner model. It keeps the companies virtual until the key risks are reduced, and the venture partners on point as founding CEOs leverages the time, focus, and experience in a given company. And then a founding position that we take allows for a majority stake up to a Series A. The next one I'd like to talk about is one of our companies that I financed in Fund 1, a company called Neuromedica. So Neuromedica came to me when I was at a cocktail, university technology transfer office, cocktail party. And this 7th-year neurosurgery resident came up to me with an idea, literally on a napkin, my first napkin deal, and said, "What do you think?" And I said, "Well, I think you need to talk to Dr. Jackson across the hall here, who is the university's intellectual property attorney. And you got to talk to him, or you can talk to me. I can't get crosswise with the university because I'm going to be doing the deals with the university." So anyway, out of that came Neuromedica. This company has just received FDA approval last summer. They have a way to close the dura of the spine, which is the leathery covering that surrounds the brain, the spinal column, in 5 minutes. Typically, this takes up to an hour now, surgical time. And surgical time, if you account for everything, the surgical tech, the circulator, the nurses, the surgeon, $200 a minute. This is a huge savings. And this is not just applicable only to neurosurgery. This is the first of our beachhead methods. So we have opportunities in cardiology and OBGYN and in several other indications. So we believe this company will be acquired within 2 years. And I put $1 million into this company about 1.5 years ago, after following them for 5 years. And I think this will be a big success. It's an ideal bolt-on acquisition for any of the large medical device companies. The other company we're involved with, my most recent investment actually in Fund 1 is a company called Immunomind. And this is an AI and drug development company. In the past 1.5 years, I've been working with them. They have used their technology and a massive data set out of Washington University, Vanderbilt University in Tennessee, to develop a drug for type 1 diabetes that they're now partnering. So that's a record rate in my experience in the drug business. Started out in the pharmaceutical business as a medicinal chemist, so I'm very bullish on this company. We have lots of high priority deal flow coming from just the past few months. I've listed a few of them here. Yep. So, a therapeutic company coming out of existing biotech that has an opportunity to deliver steroids directly to cartilage in the joints specifically. They're world experts in proteins that home to the cartilage, and thus can deliver these drugs that are too toxic to deliver for long term very effectively. Very excited about this. There's a medical device company with grant funding in place to take their first in man and pivotal trials in prostate cancer detection using MRI. So MRI is now used to detect prostate cancer rarely. Usually it's ultrasound, that's the standard of care. The trouble is ultrasound can't visualize cancer, MRI can. So again, very excited about this company, think it'll change the world. And there's several other companies we're looking at. I think I'll move on. We have no shortage of deal flow. That isn't a problem. So as I mentioned, some performance highlights. Megavax is a company that I ran and started out of university. We put in $375,000 and have now pulled out about $10 million over a 7-year period. 4D Molecular Therapeutics is a company that my partner Laura financed. It's a gene therapy company that went public, and she made a very good return on that in her last fund. Neuromedica I described earlier, which has the way to close the dura of the brain spinal column in 5 minutes, and I think that'll be a bolt-on acquisition pretty shortly. In terms of the liquid investments, Laura's performance in Berkeley Catalyst Fund, out of 25 liquid investments, 14 have positive IRRs as of last year. Number of great co-investors in terms of my portfolio in Alignment Ventures. 1 of 5 liquid investments, 3 are ongoing, 1 with an up round, and 2 have been write-offs with minimal capital investment, so $50,000 typically, and time. But you learn to cut your losers and let your winners run. So the strategy of the firm is to use general partners, Laura and I, and the venture partners in different roles. The general partners will build the firm, the SAB, the boards, the LP relationship management, and the venture partners will act as interim CEOs. In the first fund, one of us would run a company we finance. We would not, to do a deal, we have to sit around the table and say, okay, who's going to run it? That's just not viable with a larger fund like this with 10 potential startups. So we're doing it like this with the venture partners as our operational people. So in summary, this is a model for maximal gains for early stage life science investing. We're very experienced team members that invested successfully at the seed stage in life science companies. It's a capital efficient strategy. It's a strategy that will work in a recession and will maintain majority positions to the Series A. So that's it. Any questions? I'd be happy to answer.
So my first question is, I'm wondering about how you figure out duration on these investments. Like, are you looking at them firstly for a shorter duration? Because you realize some gains on some short duration. And I think one of them was 3x on a 2-year investment period.
Well, that was then. This is now, right? So no, I think we fully expect that our initial investment of $3 to $5 million will last these companies a good 2 years. So there's $500,000 that goes in. That's 6 months to 9 months. Let's say to de-risk them. Then if they pass that hurdle, they go to the second stage, which is $3 to $5 million. That $3 to $5 million had better last 2 years, and we're only financing the kind of companies that can do that.
And these are all out of leading universities primarily. I mean, so the ideas come out of the universities. You have a whole bench of great venture partners that have been in the industry for years and years. They probably had experience in one areas of head scientist or as a chief operating officer or attorney, and you figure out what the needs.
You find science first. Okay. So you find a science that really looks like it has legs, it can create products in a reasonable amount of time. It is not something that is a grant engine, right? That's very, very important because academics would love to just pile more money into their departments to get as if it's other grants. It's not that. So you have to have the acumen to realize, when it's ready to be spun out, and then you design the experiments with the founder to say, can we reduce the risk to make sure this is productizable? And only then do you put $3 to $5 million.
Sure.
That's our model.
And having prior grants though is influential. I mean,
having
non-dilutive equity.
When I started to make backs, we had Louis Picker had $45 million from the Gates Foundation and another 30 from the NIH. Yeah, grants matter. Sure.
Like I was going to say, just from the work I do in the I love your business model. NYU makes $2 billion a year just from licensing its IP. So everything you're saying, I think I don't hear of too many people like you doing it. So I think it's great. Are you mainly focused just on Berkeley?
Oh, no, all over. Well, most of the West Coast, because this is so time intensive. And if things go wrong, one of us has to go in and run these things. One of the general partners has to go in. Ideally, the venture partners are going to be carrying the operations freight. We've run companies before. If things go wrong, got to do it. Sorry.
I've listened to this pitch a number of times from different people, and one of the things that I keep hearing is that the best values in the university world are not on the West Coast. They're in Canada, they're in the West, they're wherever they are.
Right.
And that there's a ceiling that a lot of these people are now saying is, I don't care how great your idea is. If your valuation is above 6 million, I'm walking.
Yeah.
And it's
Yeah.
So my question to you is two. One, what is your valuation cap if you have one? And two, to what extent are you looking for opportunities that are in the less pricey West Coast area?
Well, my most recent successes were in Oregon and Washington. That's not Bay Area. It's a whole different world, I can guarantee you. I've done deals in British Columbia. I've done deals in Manitoba. I've done deals in Montana. I've done deals in Texas. I've been in this business a long time. Norwest Ventures is one of the oldest and largest venture firms in the United States. That's where I cut my teeth.
And in terms of valuation, you have
Certainly sub 10 million. I would think less than 6, but that depends. It's all changing. Valuations are in free fall at the earliest stages.
By saying free fall, are we talking like 80% off?
They're half what they were.
Half.
Easily.
Yeah.
Easily. And maybe more, depending on which sectors, which subsector.
It's like mostly
50% of the Bay Area, more than that elsewhere.
Yeah, I forget the name of there's a private equity fund out of Los Angeles, and they say that some of the best operators are just in college towns spread out around the Midwest or in the South, because there's just nobody funding them. So they figured out how to be
or even in California, Irvine. I've got a son who's in a neuroscience PhD program at UC Irvine.
Yep.
He's telling me about great stuff.
Yeah.
And I did a startup down there. I know that. There isn't the money in SoCal. There is in the Bay Area.
We've done a lot of stuff with Morrison Forster in San Diego and LA, and it's amazing that there's just so many talented healthcare guys out there.
Yeah.
And it's like a whole other state.
Right.
Finding the funding.
Or Texas. I've got a partner in Texas, in Houston, MD, I've done a business with before. He's done 2 venture funds, MD, 3 IPOs. There's all kinds of opportunities there. Houston, Dallas, Austin.
I met with the folks from University of California, San Diego.
Yeah, or a school I almost got my PhD from, University of Illinois at Champaign-Urbana. Laura's son is in a PhD program there. There's all kinds of stuff there, and nobody is minding that.
Is there any tax advantage perspective towards I think you're the first investor in most of these things. Is that correct?
Right.
So do you pass back any tax advantages to LPs?
I haven't thought about that. It's something I should.
There's a whole world of that. There's a guy out in Texas who does he's got a whole world of, if you're the first investor in to a venture, I think with Obama, when the Obama passed his Jobs Act, there was a special thing in there.
Yeah.
for anything over $50,000.
I'm embarrassed to say I'm ignorant about that. I've done that in Canada, in British Columbia, for Canadian residents, but I'm not aware, or I haven't looked into it.
I'm just saying it's a
Some
special.
states, if you look at Texas, they say the first $1 million in revenues don't tax from the state standpoint.
Yeah.
So every state has different programs, so that's the way they incentivize you to setting up shop or research there.
But I'm saying there's actually a tax code for first investors, and you can pass it back to LPs.
That's a great place.
Yeah, yeah. And I got that from a Texas guy who's like, he's done this in multiple states, so
Yeah.
let's see what he does.
Yeah, if I find out, I'll let you guys know.
Yeah, thanks. But anyway, any further questions?
So, Valley of Death, I mean, you're early on into this
Valley of
stuff.
Death will be gone by the time we need for a few more investment in our companies.
Okay.
It's our view. I mean, if the recession goes to 3 years and who knows? Unlikely.
I'm just saying, so what you target though are firms that you think you can either exit via a sale, they're gonna be sold.
Oh, not
acquired.
just with our money. No, we expect most of our companies to take, 2 or 3 rounds of investment. So yeah, there is some risk that, on down the line, if conditions remain in nuclear winter, that we won't be able to raise successive rounds. It will have to pony up that money. I think that's a minor risk.
But you're targeting firms that will be acquired mostly, not IPO. Or you
Could
looking
be
for
either. I mean, I think the therapeutic companies, there's a good chance that they will go down the public offering route. The device companies will almost certainly be acquired.
Excellent. Any other questions?
I read something that 90% of exits these days are more on the acquisition side than IPO, but no surprise considering the market.
Yeah, I'm not sure that's true in pharmaceutical biotech. It's certainly true in device.